class, depending on the time of the day that you are accessing this recording. This is a refresher for accounting for a manufacturing enterprise. And as promised, two important parts of this refresher are the ledger account for a manufacturing business, the ledger account, and the second part of it will include the statement. So we will have a production cost statement as well as a trading statement. All right, so in your reading, please do go through the introduction as well as the terminology chart, and with definitions that we've already covered in this module, such as the direct material or raw materials, the work in process inventory. You would hear me use work in progress, unfortunately by just by habit, but it's work in process. The two are definitely basically saying the same thing. And then you do have your finished goods, which is also an account, indirect material, direct labor. Obviously, direct material will be in contrast to the indirect material will be in contrast to the direct material, and indirect labor will be in contrast to the direct labor. And then you do have the factory overhead cost, and as well as a difference between the fixed cost and the variable cost. And as you know, the difference will be in how they relate to the number of products produced. And then you would have your production cost, which encompasses all the costs related to the manufacturing of products, right? But here is now the most important part. These accounts, these general ledger accounts, and as you will see, there is quite a progression within this account. As I'm pointing here, the work in process account will precede the finished goods. Obviously, if you do recall your economics module, you would recall there is input to the production as well as the actual transformation or production, and the finished product are the outputs. It is the same principle here. You do have your direct material, your direct labor, as well as your manufacturing overhead coming together as inputs for the work in process, which is your actual manufacturing or production part. And obviously what will come out of there, of that, is your finished goods. All right. So you would have your work in process accounts or your manufacturing account, your finished good. And after your finished good, obviously, again, the logical progression would be once you have your finished good, then those finished goods would be traded, will be sold. You have your sales account. And obviously, if we are talking about a sales account, we need to also balance it with the cost of sales accounts, right? Okay, so this now becomes the most important part, because this constitutes format for these different ledger accounts. You do not have to memorize this as such, but you need to have an understanding of the actual progression that I talk about, which I'm going to show you more. It's quite exciting how I'm going to show you the logical progression between these accounts that you, if you understand, will have no problem to ace your written exam at the end of the semester. All right, so for example, we're looking at the direct material. So the first thing, like I said, one of the main inputs for the production is the actual raw material or the direct material. So on your debit side and on your credit side, remember this is ledger, accounting ledger are like a balance, like a scale that balances weights, right? So it is very important to understand that there is an element of balancing your left side with your right side, your debit with your credit, you see. So it is very important that you remember, again, your accounting module 101, right? Okay, so as usual, remember, for all these accounts, you would need to look if there is an opening balance, meaning things that came from that were left out from the previous production period. That's what will be your opening balance. So let's say that, last year there was a production, they didn't use up all the material. So the material that was left last year will be our opening balance for this year, for this year or this production year or this production period. So the opening balance, the closing balance is a very important element that you always need to bear in mind. So you do have the balance, the opening balance, and then you have trade payables. Trade payables, what does it tell you? It tells you about the purchases that were made on credit. Trade payables. So these are the purchases that were made on credit. All right. As you can see, this is what is being debited. It means that this is the money that is going out of the company in order to acquire, to bring in these raw material. Okay, so other things also to take into account. Obviously, you would have purchases that are made. Those purchases, whether they are on credit or cash, all needs to be taken into account. But also other elements such as carriage, railage, as well as shipment. So everything that will take those materials and ship them or deliver them or make them ready on site for the actual production. All these costs, as on the previous chapter, need to be taken into account, right? So like I said, debit meaning that the money is going out and we are receiving the material back in, and that material needs to be allocated to the work in process. As you can see on this side, on your right hand side, you do have the work in process. It means that whatever materials that has come in will be allocated, will be sent to the actual production or manufacturing, right? So, but it's not only material, right? As you know, it's also the labor. People who are going to put this material together or who are going to transform this material in order to produce or in order to manufacture goods, right? So that will be your direct labor, as you can see here, and your factory overhead cost. Like we say, everything that is indirect, as you can see on the factory overhead cost, you would get elements such as factory maintenance, factory electricity, the rent for the factory. And I have to clarify again, not the rent of the entire company, but the rent that goes toward actual manufacturing, depreciation of equipment, indirect materials. So all these elements form part of what we call the factory overhead cost. But I want to bring your attention here that on the credit side, you always have this work in process, right? And these accounts needs to balance, right? Okay, so everything that has come from the direct material, direct labor, and the factory overhead needs to balance with what has been sent for production. So now also have an account that is called the work in process. That's the main manufacturing account. So the work in process, obviously, on the left-hand side, we will have the opening balance. If there is an opening balance, need to be taken into account. But we have these three things, three musketeers, like I call them, which are your direct material, your direct labor, and as well as your factory overhead. These three things, once they are summed up, they need to be taken into account into your work in process. So meaning that this is what came in, this is what came in, and what will come out on the other side is the finished good, and these need to balance each other, right? These need to balance each other, right? Okay, so if you look at the balance here, obviously the work in process, and that's why these annotations are very important for you to remember and to bring your attention. So please always look at these annotations as being very important. Look at the work in process. If you take the work in process minusing the finished good, you get what is unfinished good for the year, right? So the balance here will be what is the unfinished good, or the good that was not complete, that did not become the finished goods. Okay, but on your right hand side, you will get the finished goods, right? Cool. So as you go, the natural progression will be after the working process, as I was saying, there will be now the finished goods. And ladies and gents, I have something for you here that will help you, and this will be very important for you for your actual exam. Trust me, because when you are doing your written exam, and like I said, you need to have this pictured in your mind. It's very important. So like we said, the input, the direct labor, direct material, and factory overhead. And as always, you look on your right hand side, there is the work in process, right? So these three elements, these three input will be sent into your work in process. After your work in process, the logical progression is once the product have been transformed, then we will get finished goods. So at any time, this direct material, direct labor, factory overhead, that what will come in and what will go out is the finished good. All right. So this finished good will become an account in itself, right? And on the right hand side, there will be the work in process, right? As well as on your left hand, your left or your right, depending on how you're looking at it. On the other side, there will be the cost of sales, because we need to find out the cost of manufacture of these finished goods, so the cost of manufacturing these goods, right? And this will become an account in itself. So after work in process, there's finished good. After finished good, we will look at the cost of sales. After the cost of sales, we'll look at the trading account. After the trading account, we will look at the profit and loss, right? So there's a progression there. But this progression, I have put it in another form for you to better view it. You see, it's always about providing you multiple angles for you to understand your learning units, right? So this is another angle. When you see there is work in process, after the work in process, there will be finished good. So you can see on the left and on the right. What will be on the left? Obviously, when you're looking at the work in process, what comes in are our three musketeers, like I said, direct material, direct labor, factory overhead, that will be on one side, and on the other side, we want what will come out is the finished good. Now, the finished good will be an account in itself, right? We will look at the finished good. What would have come? Would we be looking at? What comes in to be finished good is what came from the work in process. So on one side, what came from the work in process. On the other side, we need to look at the cost, right? Because we need to balance the cost of sales, right? So on the other side will be the cost of these finished goods. And let me again be clear. So it is the cost of manufacturing this finished goods. It's the cost of manufacturing these finished goods. All right. So and the cost of sales will be um, an account in its own right. And what came previously, again, look at this crisscrossing. If you keep this in mind, you are sorted, right? Look at this crisscrossing. It means that what came before, the finished good would be on the one side and the trading account on the other, because whatever whatever has been estimated as the cost of the production that you have made needs to be traded, right? Needs to be recovered. That's the meaning of why we are putting the trading account. The trading account simply means that we need to recover the cost of production in order for us to ensure whether, in order for us to determine whether we are making a profit or we are making a loss. That's the meaning. So the trading account is important, is very important. And the cost of sales on one side needs to match the sales on the other side. Meaning, in order for us to break even, the cost of sales needs to match the sales. Obviously, for us to make profit, sales needs to be greater than the cost of sales, right? So therefore, there is also a profit trading account. All right, so let's now move quickly into now the practical example. So we have covered the theory part, and I've provided you wonderful visuals for you to use that will allow you to better remember. But now let's look at an example. Example 6.1. So we have the direct material. As you can see, I have battered you with all these arrows, but they are important for you to see that I am taking every line of this example to understand where it fits. For example, the credit purchase for direct material, this speaks to the direct material. For example, transportation cost of direct material, this will speak to the direct material account. All right, so that's what this means. Okay, so this cost, obviously, you always need to also look, are they accounts that have an opening balance and a closing balance? And lo and behold, if you look down here, direct material, work in process, finished goods have opening and closing balances. So these need to be taken into account. So when we're looking at the direct material account, for example, we need to take into account what is the opening. And as you can see here, this is the opening. It's 189,000 that was the opening balance, plus the credit purchase and plus the transportation cost. We add them up together and this gives us a total. Now, this total needs to be on both sides. So you need to replicate this total on both sides. But is there a closing balance for the direct material? Yes, there is a closing balance, and it's 174,000. And this is what we place here. So 174,000 is, if you would allow me, is, this is 1,000. Obviously, it's not 174, but 174,000. Forgive me for getting this. All right. So 174,000 will be the closing balance. It is the closing balance, meaning that we don't need to take into account, because this closing balance will be taken into account the next production period. We take into account what we received from the previous production period, and obviously what we purchase, whatever material we purchase for this production period. But as you can see, we're leaving out what is the closing direct material, closing balance, right? Okay, so this closing balance needs to be also on the other side, which is quite interesting, but this time as a credit, not as a debit. But this time the debit must match the credit. So it needs to be on the other side. So how do we get the work in process? We get the work in process by just taking this total, minusing the credits that we have, and we get the work in process. So please understand this part, that this balance needs to be replicated on the other side. The debit must match the credit. So the closing balance will also be replicated on the other side, and it will be useful for us to get what is to be allocated to the work in process, right, for this particular production period, right? So then let's move on again to the direct labor. Obviously, it's not only direct material. Like I said, we have the three musketeers. It's not only the direct labor, we have also the direct it's not only the direct material, it's also the direct labor. So the people who are going to do the transformation of this direct material. And for the direct labor, it's rare to get an opening balance, because these are people, obviously, right? So whatever was allocated to the labor, to the direct labor, is 147,000. So the 147,000 stand as it is, and it needs to be balanced also on the other side. Like I said, this is a total, right? So it is a total. You can see on the other side, there is the same amount that will be allocated to the work in process. And the last account that constitute part of our input is the manufacturing overhead. And as you can see here, manufacturing overhead include things like indirect labor, indirect material, maintenance, factory, sundry, and all that. All right, so as you can see here, it's quite clear here that we do have the manufacturing overhead. And let me just reiterate that all these elements belongs to the manufacturing overhead. But as usual, do not remember from the previous chapter, we are only looking at the manufacturing overhead. Manufacturing overhead, meaning that maintenance for the factory, yes, it is taken into account. Maintenance for the factory. Electricity, for example, there is a part of electricity that goes to the manufacturing, and that is only 75%. So from the total that is given to us here, 189,000, 75% of that will be allocated to the manufacturing. So that's what is to be remembered here. The rent, for example, what is related to the factory is 80% of the rent. So only 80% of the rent needs to be taken into account. So as you can see, straightforward. Do we need to take the depreciation of factory equipment? Absolutely, because this is for the manufacturing, depreciation of factory equipment. But we are not going to take into account depreciation of office equipment. That we will not take into account because it's unrelated to the manufacturing. The salaries of the administrative not be taken into account because it's not related to the manufacturing. The selling expenses will not be taken into account because it is not related to the manufacturing. So, all right, so this provides us a total, and this total will be allocated to the work in process. And as we can see, now we can come to the actual work in process. All right, so for the work in process, now you need to check what are these accounts that had an opening balance and a closing balance. Direct material was one of them, work in process was the other, and the finished goods. So there is an opening balance of 126,000, and as you can see, that will be the 126,000 that we have here as an opening balance, right? Plus we take our three musketeers, right? The direct material, direct labor, and direct manufacturing. These came straight from the different accounts. We take them, we place, and this provides us a total. Obviously, remember again, we need to separate it from the closing balance, because that we are not taking into account, right? That's the closing balance here. But remember, the balance, the debit must match the credit, and as you can see, this will allow us to find out what is the finished good, the finished goods amount. So this is the amount that is allocated to the finished goods. And so after the working process, we have the finished good, and the finished goods as it is would be an account in itself with a left and a right. Okay, so on one side, as you can see, we would have the finished good on one side, the finished good that came, the 953,000 will be the what is coming from the working process. So the finished good that came from the working process is this one. That's the amount that we are looking at, right? That's the amount. So as you can see here, it came from the working process account, finished goods side. This is the one we're gonna put it into. We're gonna replicate here on the right hand side, depending on how you're looking at it. Left for depending on how you're looking at it. So, but on one side there will be the working process. On the left hand side there will be the working process, right? The balance, the finished good balance, the opening balance, there was an opening balance, meaning that came from the previous production period. This was the amount. Can we double check it? Yes, the 157. As you can see here, 157 for the finished good was the opening balance. So meaning it's what came from the previous year of production. We need to add up what was produced, came from the previous year of production, plus what we produced, the finished good that were manufactured. Both of them gives us a total, and like I said, this total needs to be replicated. D needs to be on both sides. What we are not taking, what would be outside, is the closing balance, because the closing balance is what was unfinished. The closing balance is what was unfinished good. So we don't need to take into account, right? But what is the cost of sale, therefore? What is the cost of sale? Like I said, debit and credit must match each other, so this balance needs to be replicated, which will allow us to obtain, to work out what is the cost of sale. Right, so we have cost of sales. Obviously, in this example, we do not have the other accounts there. Remember the other accounts. But in the following example, 6.2, that we will get to cover those accounts, which are the cost of sales. So remember previously we were looking at the finished good, which would have on one side the work in process, the work in process, what the finished goods that came from the work in process, right? And the cost of sales on the other side, right? So the cost of sales will become, remember again this progression, very important. So the cost of sales will become an account in its own right. And we need to balance the finished goods, right? We need to balance the finished good and the trading account. And if you remember, let me remind you again what I said there is a reason why we're including the trading account, because we need to cover the cost of sales in order for us to make a profit, or in order for us to determine whether we made a profit or we made a loss. We need to cover when we are trading, we need to cover the cost of sales. That's why you will have cost of sales that came from the finished good. As you can see, this came from the finished good, this came from the finished good, and on the other side this needs to be traded, right? And this needs to be matched in order for us to break even, right? Okay. But now when we're looking at the trading account, meaning when the actual trading happen, what are we going to look at? We're going to look at the cost of sales and sales, the actual trading, the actual selling. We're selling the finished good in order to get money in. And that's how we get our profit. Remember, sales minus cost of sales gives us the gross profit. All right. And obviously, if the sales is greater than the cost of sales, we know we've made a profit, right? If the sales is greater than the cost of sales, we know we've made a profit. If the sales is lesser than the cost of sales, then we know that we made a loss, right? Okay. So here it's easy to work out. So we take the cost of sales, which is the amount here, minus the sales amount minus the cost of sales gives us profit and loss. Remember, this is the only thing to be worked out. That's why you will see this TBWO, to be worked out. That's the only thing. So I'm giving you an indication of what is given and what is to be worked out. Right? What is to be worked out. So you take what is given and you work and you work out the unknown, right? And so we have a profit, right? We have a profit. So if you do remember properly, for in your income statement, you always get the sales minus the cost of sales, then you get gross profit, right? So when you get a gross profit, in order for you to get the net profit, the actual net profit, you need to minus other expenses. And here the profit and loss account. The profit and loss account is to show us what is really the actual net profit. So that's why on your right hand side, you will get your trading account. Obviously, this is the only one that provides you the trading account. Normally, the trading account should be this side, right? All the accounts are the same. If you remember here, all the accounts, the previous account always is on the left side, and the next account will be on the right side. Previous account will be on the left side, and the uh, the other account will be on the right side. But at the exception of the profit and loss, trading account will be on your right hand side. Just wanted to point that out to you. So remember, these are visual pictures that are provided you to allow you to understand this progression, right? So as you can see, for the profit and loss, so the trading account on one side, as you can see, the trading account will provide you what? The profit and loss. So you take this profit and loss, this profit, actually it's a profit because remember, the sales was greater than the cost of sales. So it's a profit, and the profit is 284,000, right? 284,000 is your profit. So now we want to find out what is the actual net profit. So we are minusing these. If you remember these: electricity, maintenance, insurance, distribution costs, advertising, salary. But you would want to say, Patrick, but these are overhead. Didn't we use the overhead already in our manufacturing overhead? I say yes. Remember, the manufacturing overhead was used at the beginning. Manufacturing overhead went into the work process. This has nothing to do with manufacturing overhead. This has to do with admin as well as advertising or marketing and advertising cost, right? So not to be confused. Like we were saying, remember that, for example, in this example, you will get insurance. There's insurance that belongs to the factory, and there's insurance that belongs to the administrative offices. And if you look here, this insurance that belongs to the administrative offices is 3,000 rand. And when you look at the profit and loss, the insurance that is used is this one that belongs to the administrative offices, right? So not to be confused with manufacturing overhead. These are admin overhead, right? Admin overhead, or admin, if you remember, admin, marketing and advertising costs, right? So here they are. So it makes sense, because remember, when you were looking at your income statement, you will get your sales minus the cost of sales, and when you get your gross profit, you will minus other costs, other expenses incurred. And this is the section where the other expenses are taken into account. So we put all this electricity that belongs to the offices, for example, not electricity that belongs to the manufacturing, maintenance that belongs to the belongs to not the manufacturing. Let's see here, maintenance that belongs to the administrative offices, not to the manufacturing, right? So you take all of these into account, and therefore we can work out, therefore, what is the actual, like we say again, the total of the profit and loss is here. This is the total. And for us to find the net profit, we'll take the total gross profit that we got, minusing these other expenses, then we get the actual net profit, right? So this is how you see all your account. So our first part definitely covered this for you, shows you the progression. Remember again this progression of these accounts. You will say, well, it's very difficult to remember all these accounts. No, there are only 5 of them. Remember, there is the input account, direct labor, direct material, factory overhead, those that are called the 3 musketeers. These are the inputs. But when you're looking at the actual progression of accounts, you have the work in process. After the work in process, after you've done the actual transformation or manufacturing, you will obtain finished goods. After you obtain finished goods, you will look at the cost of producing those finished goods, right? And after you're looking at that cost, you look at the trading account, because the trading account must cover the cost of sales, right? And after the trading account in itself, after you're looking at the cost of sale, the trading account in itself will have now the actual sales that took place. And the actual sales and the cost of sales needs to be balanced for either to know whether there was a profit or whether there was a loss, right? Okay. So this is the first part. I have totally the part for you. There are few examples that are here for you to continue practicing this. Please practice. And should you struggle with anything, get back to me. And I've provided you beautiful tool, meaning that if you're looking, for example, at question 6.2, you can go straight to the solution by just clicking on this solution. It will take you straight. Question 6.3, if you click on the solution, it will take you straight there. Okay, the second part of this learning unit obviously covers the production cost statement. So you have the production cost statement as well as, like I said, the trading statement. The trading statement is just a small statement that talks about the sales minus the cost of the finished goods sold, not the finished good produced. Again, just look the difference here, not the cost of the finished good produced. There's just a little bit of difference here. The cost of finished good sold. And then that will provide us with the gross profit. So that's the whole statement. The trading statement is just sales minus cost of finished goods sold and gives you the gross profit. And the production statement, what does it contain? It contains, again, those main accounts, direct cost, all right? Direct cost, all your direct cost, remember, and your factory overhead. The three musketeers are here. So the direct cost will have the direct material cost, the direct labor cost, and the factory overhead. The three musketeers, again, appear. Here they are, the input. So that will provide you the total manufacturing cost. And simply you will add the opening work in process at the beginning of the financial year and the closing work in process at the end. You are taking what came from the opening work in process, meaning that what was unfinished, what was unfinished in the last production period is now taken into the new production period at the beginning of this new production period. So therefore meaning that we added, but we minus what will be left over, meaning the closing work in process. That's one, meaning that these are material, labor, factory overhead that was not used in this production period. So I trust this makes sense. Why are we doing this? Is for us to find the cost of production of finished goods. Because this cost of production of finished goods is the one that we're going to use in our trading statement. I trust that that is clear. So all this, the three musketeers, plus the opening work in process, minus the closing work in process, will provide us the cost of production of finished goods. And that cost of production of finished goods, minusing that from the sales that we are going to make, will provide us the actual gross profit for the production period. All right, so these are just, again, the notes for the financial statement, meaning the direct material, how you would calculate the direct material will be slightly different from the ledger account. Remember the ledger account, there is a balancing. Remember, there is a balancing. It's almost like a scale. So there's a one side and the other side that needs to balance each other, which is not the same when you're looking at the statements themselves. Here, we would just take the opening inventory that we have, all right, plus whatever was bought, all the purchases of material that was bought, plus, like I said, remember again, the freight, cost, custom duties, whatever cost that will be incurred to move those materials to bring them close to the production, we all take that into account, right? Okay, so the opening inventory plus the other that we bought, minusing the closing inventory. In other words, this side of things is basically when you're looking at the ledger, when you're looking at specifically, you can see that if you're looking at the ledger specifically, when you're talking about direct material, the statement, the notes for the statement just take this one side into account. So they are more interested into the money that went out in order to bring the material in. They are interested in the debit side of things. Money was debited in order to acquire material, right? So it's only taking one side, right? So direct material cost, opening inventory, plus what we purchased for the year, minusing the closing inventory. The same will be for direct labor. But the direct labor, obviously, you will not have people that came from the previous production. Like I said, labor are people. Therefore, we more take into account their wages and other contributions that are made towards employees, right? Towards, this will be your UIF contribution, medical aid contribution, pension fund contribution. We take all that because these are added up as well to the, but remember again, these are factory wages. These belongs to the manufacturing, right? Not to the admin, not to the marketing team. No, this belongs to the manufacturing. And we have, in the end, the factory overhead cost. All right, so the factory overhead cost will have all your indirect material, indirect labor, depreciation of factory machinery, electricity for the factory, telephone for the factory, insurance for the factory, rent paid for the factory. These all will be taken into account and added up together, right? So the purpose of these three musketeers, as you can see, will provide us the total manufacturing cost. So once we have the total manufacturing cost, then we can look at now what was the opening working process, meaning what was left from last year. What were the material that were used? What was the material that was supposed to be used last year that was not used in last year's production, but we can use it in this year production? So meaning it's a plus. So to the total manufacturing costs, we add what came from last year, but we're going to minus what we're not going to be able to use this year. Because we're not going to be able to use it in the production, to the production, which is the working process, we need to put it aside. We don't take it into account. That's why it's a less the closing work in process, right? And this provides us, what does it provide us? The cost of production of finished goods. This cost of production of finished goods, ladies and gentlemen, is the one that is going to help us in the trading statement. All right. So the trading statement will be sales minus finished goods sold, the cost of finished goods sold, which will provide us the profit. Are there examples? There are plenty of examples. And here is, for example, here is an example. And as you can see again, I provide you every single item. I'm showing you where this single item fits, in which account it fits. And as you can see, you will need to do the direct material, you will need to do the direct labor, you will need to do the manufacturing overhead. MO is just another way of saying manufacturing overhead. So once you get those totals, like I say, this, if it's a bit messier, don't worry. I provided the actual textbook. This was just to show you the arrows again. I love to show you the arrows, which cost goes where. Right? So, but this is actually the direct material cost that we obtain. This is the total of the direct material cost for the production, the direct labor cost, as well as the factory overhead cost, right? So these three will go to provide us with the total manufacturing cost. And like I said, we need to add what came from the previous year, the opening work in progress, and what we are not going to use, which is the closing work in progress, what we're not going to use this year, which will provide us the total cost of production of finished goods. All right. So very simple. All right. So another thing here, if I can add, is number 4. Number 4 is the cost of finished goods sold. The cost of finished goods sold. So if you can see here, look at the cost of finished goods sold. The cost of production of finished goods is not the cost of finished goods sold. This means that this is the cost of all the goods we've produced. But the good that we've produced doesn't mean that all the good that we've produced will be sold at the end of the year. I repeat, all the goods that we've produced, that does not necessarily mean that they are going to be sold at the end of the year. All right. So I just want to remind you, maybe perhaps previously I didn't state it correctly. So this cost of production of finished good will help in determining the cost of finished goods sold. So let me just be clear on that. So these two are not necessarily the same. My bad if so these two needs to be contrasted. They are not necessarily the same, okay? So this need to be contrasted, right? So this is a live amendment that I'm making. So the cost of production of finished goods need to be contrasted with the cost of finished goods sold. So there needs to be there a difference. This is how you calculate the cost of finished goods sold. You need to take the opening inventory of finished goods at the beginning of the financial year, plus the cost of finished goods produced. Right? So you will take this, the cost of finished goods produced. All right. So which will minus the closing inventory of finished produced, which will provide you this. So this is a live amendment. This is a live amendment to say, please, just clarification. I just saw that I made a mistake here. The cost of production of finished good. And let me repeat again, this is the logic. Whatever we've produced this year does not mean that whatever we've produced does not necessarily mean that what is going to be sold. We can produce 10 shirts, but we only sell 9 shirts. All right, so we need to see that into account, right? So how will we know how much we have sold? We're going to take the opening inventory of finished goods, meaning that the finished goods of last production, the finished good that came from last year, that we take into account this year. So we're going to take those into account. And the next thing that we are going to take into account is now the cost of the finished goods produced during the year. So this year, that will come from your production cost statement. Your production cost statement is meant to provide you with this cost for this year, the cost of production of finished goods. So all the finished goods for this year, what is their cost? All the finished goods for this year, what is their cost? We add the cost of finished goods that came from last year, as you can see, minusing the closing inventory of finished goods. So the closing inventory, it means that whatever is going to be left over at the end of the financial year. So we have the opening inventory of finished good, the finished good that came from last year, plus the goods that we produced this year, minus those that we are not going to sell. That's what gives us actually what was sold. So what was not sold, the finished goods that were not sold. The closing inventory of finished goods is the finished good that were not sold. That's it. So whatever came from last year plus what we produced this year, minusing what we are not going to be, we're going to be left with. So we last year we had, as an example, 5 shirts. This year that were left, that were unsold last year, that came from last year. This year we have produced 10 shirts. And so we need to look at what will be left. What will be left? If 5 will be left at the end of this year, it means that we've only managed to sell 10 shirts. So what came from the previous year plus what belongs to this year minus what will be left unsold will give us. So this is basically the logic of this. So the cost of finished goods sold. So again, I repeat, the cost of production of finished goods must be distinguished from the cost of finished goods sold. What we produced does not necessarily that's what we sold. So produced and sold are 2 different things, right? So this basically wraps up this learning unit. And like I said, there needs to be a practice that you are making. Please practice this. The examples are here showing you clearly how you get what. How you get what. Showing you clearly how you get what. And let me know if anything does not make any sense. I will cover again. And that's it, guys. We're not going to have the time to cover everything. But like I said, even from the other examples, you will have the same thing. I've provided you actually the questions and the solutions next to each other. So if you see this link, please feel free to click on it. When you're looking at a particular question, you want to find out what is the answer or the solution. Solution for question 6.6. Here is the solution. You just click on it. It will take you straight to the solution. So these are some of the other examples that you can cover in your own time. But the point is that you may take the time to practice. Please practice. The main examples of this learning unit have been covered, and we will keep in touch for our last chapter for this semester, which will be learning unit 7.